thanks very much, Randa. As Randa said, I'll be presenting our latest forecast on the global economy. Just to explain, my part of the presentation today will be in three parts. The first covers the global economic outlook, where we highlight the main macroeconomic trends that we've highlighted for this year and next as well. I should just give a caveat here. We've yet to actually officially launch this year's Trade and Development Report, but I will be sharing our GDP growth estimates with you, but just keep in mind that these are still preliminary, and it is possible between now and the launch of the TDR in a few weeks that they could change, but I'll be sharing the latest estimates we have are the ones I'll be sharing with you. Now, after covering the global economic outlook, I'll also be presenting a section that's in the report on the role of the US dollar in the global economy, and finally a section on external imbalances, specifically looking at external balances through the prism of internal imbalances, but we'll get to that. Now, what can we say about 2025? Well, clearly it's been a bumpy road for the global economy over the course of the year. We have seen a series of policy shifts that have had far-reaching and profound consequences and implications across all four corners of the globe. Most significantly, the issue of external imbalances, has been at the front and center of the global policy debate this year. And we've seen a broad resetting of trade policy in response to these external imbalances. I'd say this shift in policy is probably one of the most significant global economic policy actions we've seen in decades. Perhaps the last time we saw such a seismic shift was probably at the outset of the 1970s, when the US administration at that time took the decision to end the US dollar convertibility to gold, and that of course brought an end to the Bretton Woods system of global fixed exchange rates. Now in this case, I'd say what we're experiencing is a fundamental reshaping of the rules and norms that will potentially govern global commerce in the years to come. In the near term, the distortionary impact of these policy shifts and the elevated uncertainty accompanying them clouds prospects for global growth both this year and next. As such, we're estimating a further deterioration of already subdued global growth this year to a muted 2.6% expansion for the global economy. Here in the chart, you can see the blue bars here. They represent annual global growth for the global economy. And as you can see, the growth figure for this year, I should say that the last 2 years, 2025 and 2026 here, of course, are our estimations, our projections. And as you can see, the growth figure for this year reflects a significant slowdown from last year, as well as from the pre-pandemic trajectory. In fact, the expected expansion this year is the lowest in over 20 years, excluding the years of the global financial crisis and, of course, the COVID-19 pandemic in 2020. Looking a little closer at the different factors at play, clearly the resetting of trade policy, together with the high levels of uncertainty we've seen surrounding those changes in policy, have led to an increasingly challenging external environment. At the same time, subdued investment spending, aside from investments concentrated in certain sectors, most notably in artificial intelligence, as well as burdensome debt overhangs and constrained public spending, persist in many countries. These factors have been weighing and continue to weigh on growth prospects, already weakened by a series of shocks in recent years. Now, of late, there's been much talk of a certain resilience in growth numbers, specifically in the first part of this year. And to be sure, we have seen numbers for the first and second quarters of this year that have beaten a lot of expectations and have been stronger than a lot of us had thought. And even the estimates that we have now, they've moved up in the last 2 or 3 months. Probably 2 or 3 months ago, we were estimating lower growth for this year, and now the situation seems to be a little better. But it's important to not lose sight of the fact that we continue to foresee a fairly downcast growth performance for this year and for next year as well, for that matter, which I'll come to. So we believe the apparent resilience in growth numbers in the earlier part of the year is likely to prove temporary. In fact, the resilience is mostly a product of front-loading imports and purchases, which, let's say, muddied the growth trajectory during the first part of the year. Now, when we refer to front-loading, this is essentially the practice that we have seen that in anticipation of tariffs, and also when tariffs have been applied but then postponed for a certain length of period, both firms and consumers have taken advantage to front load, to bring forward their purchases and imports before those higher tariffs take effect, and obviously the cost associated with those goods goes up. So that front loading had a temporary positive impact on outward trade flows and on production levels, which were ramped up to meet this temporary uptick in demand. But of course, it's front loading, so there is a subsequent drop-off to this trend. So that subsequent drop-off, which we expect to see, will negate any positive impetus that we've seen from this phenomenon. So as a result, we believe that the positive performance we saw in the first part of the year will not be sustained. And to a large degree, the seemingly positive trajectory, it masks or covers broader, longer-term weakening activity that we think will become more evident and clear as new quarterly data releases come out. Similarly, the impact of trade policy shifts on global value chains is ongoing and hasn't yet been fully internalized. But even though we haven't seen it necessarily so far, the vulnerabilities of these production processes to sudden shifts in trade policy, which we've seen, are clear and evident, and there are likely severe disruptions to cross-border production lines, and that will inevitably hurt economic activity globally. And specifically, those economies dependent on value chains linked directly to the United States are particularly exposed to the fallout from those trade policy shifts. So turning to next year, we foresee that the slow expansion will persist. Again, we're expecting 2.6% global growth next year. And that's in a context of economies seeking to adjust to the evolving external environment. Now, for next year, although we do expect greater clarity on the longer-term policy environment, we also foresee ongoing disruptions and dislocations in international production processes, as well as increasing economic fragmentation that are likely to continue holding back any potential rebound in global economic activity. Now, as I said before, while there is the prospect of a positive boost from investments in particular sectors, most notably AI, we don't believe and we're not convinced that this will be sufficient to offset the deterioration in the global economic environment. Now, probably the other main headline for this year has been the issue of uncertainty. As we can see from this chart, while policy uncertainty has dropped from the unprecedented highs that we saw back in April this year, around the time of the initial announcement of reciprocal tariffs. In the aftermath, of course, of that announcement, we saw widespread turbulence in international financial markets. So while we have seen uncertainty levels come down from those highs, they do still persist at historically high levels. And that reflects, I would say, ongoing unpredictability about future trade policy, although not limited to future trade policy, but most importantly to future trade policy. Specifically, the volatility that we've seen accompanying those policy shifts. There have been frequent announcements, postponements, and pending details depending on agreements that can be reached on a bilateral basis. That unpredictability about those trade policy shifts has been a key factor hampering global growth. And it's important to make a distinction between the impact of the policies themselves and the impact of the uncertainty and unpredictability around those policies. Specifically, uncertainty can be uncertainty can be particularly damaging to economic growth because it complicates firms' decision-making. It impacts business spending and capital expenditures, as companies typically prefer to delay investment and hiring decisions until the policy environment becomes a little clearer. And recent studies have demonstrated that elevated policy uncertainty, particularly around trade, tend to coincide with downturns in exports, in investment spending, and in overall economic activity. Now, the tariff rates that took effect on the 7th of August, it's true they have brought certain clarity to the new trading scenario. But there is still the potential for future rate adjustments. And that means, I mean, we've seen examples of that recently with Canada or India or Brazil on other factors which are not really related to trade. We can see sudden changes in tariff rates. So in the context of that uncertainty, we expect that that we will continue seeing firms spending and investment decisions to be delayed and to be more cautious. Now, the downturn in growth prospects cuts across countries. The direct impact of trade measures, along with their indirect effects through trade linkages and elevated policy uncertainties, as we discussed, has led to a general deterioration in the global environment. That said, certain regions and countries are more vulnerable to the adverse international context than others. Here, on this side and the next, we have a series of charts that just shows the growth rate, annual growth rate, by different countries and regions. In the case of the United States, economic activity is expected to slow as increased tariff rates on supply chains have a detrimental impact on industrial sectors and the service sectors that depend on them. Ongoing policy uncertainty also continues to weigh on investment and private consumption in the country. And on the positive side, equity markets have rebounded from the large losses that were seen in April. And specifically in the US, investments driven by AI have proven to be particularly strong. But again, those positive trends do not compensate for the shortfall in consumption and investment spending that we're seeing. So we expect the US economy to register a significant deceleration this year to 1.8% growth, and again to decelerate next year down to 1.5% growth. In the European Union, growth is projected to remain fairly sluggish, despite reaching a deal with the US to set tariffs for the EU's exports at 15%, which is a significant improvement compared to the rates that were initially announced back in April. But even so, trade frictions could dampen growth prospects, particularly for countries more dependent on sales to the US. Now, while the agreed baseline, as I said, tariff rate does provide some policy clarity, the prospect of new sectoral tariffs and potential exceptions could keep policy uncertainty high and continue to hinder business investment. On the positive side, ongoing monetary loosening will help to ease credit conditions in the region, and it will also help to boost private consumption. Specifically, there's a significant expansionary pivot in Germany's fiscal stance, and that should provide some growth impetus for the country and also for the region, given Germany's important weight in the EU's regional economy. But that said, we anticipate ongoing subdued growth in the EU with expansions of 1.3% this year and 1.4% next year. Now, turning to the developing economies, in China, solid economic growth occurred at the beginning of this year. However, in the latter part, increased bilateral tariff rates have become a drag on output growth. Although we did see a rapid diversification in export markets by China as exporters were able to reroute goods shipments to alternative markets. At the same time, we've seen an expansionary fiscal policy that's been focused on subsidies for consumption goods, transfers to households, and increased outlays for infrastructure. as well as monetary loosening. And all these factors have helped to support growth in the country. So therefore, we only expect a very gradual moderation in the growth rate to 5% this year and 4.6% next year. Now, in the rest of the Global South, a challenging external environment will impact growth prospects, particularly as many countries are exposed to fallout, directly exposed to fallout from trade policy shifts. Much of the negative consequences of the recently introduced tariff barriers on these economies have yet to be fully felt, since the front-loading, as I talked about, of goods provided a temporary lift to global activity. But as this front-loading begins to wane, we expect growth to decelerate accordingly. Economies most integrated, as I said, into global value chains, tied to demand from the United States, and those are the economies that have seen the largest boost from the front-loading, will likely experience the sharpest downturn subsequently. And reconfigured supply chains and weakening investment globally will have large impacts on growth throughout the Global South in the latter part of this year and next year. Now, the deterioration in the international environment affects developing economies through both trade and financial channels. Policy shifts reverberate in increasingly volatile international financial markets, which leads to greater instability in capital flows and in exchange rates, as well as worsening international financing conditions. So developing countries are particularly susceptible to movements in these variables, especially those with high external financing and refinancing needs, and those with high external debt burdens. So broadly speaking, we expect fairly lackluster growth in the Global South in 2025, with many of the developing regions experiencing a slowdown compared to last year. So excluding China, growth in developing economies on aggregate is expected to remain at 3.7% this year and to rise only marginally to 3.8% next year. Looking a little more specifically at the different regional levels, developing economies in Asia, excluding China, are expected to see a slowdown in growth to 3.8% and to pick up marginally to 4% next year. Economic performance in Southeast Asia is particularly impacted by the shifts in trade policy. On the brighter side, the economy of India, the Indian economy, continues to exhibit very strong growth, thanks in large part to continued strong public spending and private investment. Western Asia is also expected to see a pickup in growth to 3.1% this year and further to 3.7% next year, and that's on the back of increasing oil output as well as dynamism in specific non-oil sectors. In Latin America and the Caribbean, growth is expected to remain fairly weak at 2.1% both this year and next. The region's exports are especially affected by trade measures in their principal destination markets, as well as elevated borrowing costs, which are weighing down on domestic consumption and investment in several countries in Latin America. In Africa, growth is estimated at 3.7% this year and 4.1% next year. Now, a few African economies are experiencing rapid economic development, but a combination of global factors and specific domestic conditions are holding back the regional aggregate. Specifically, cuts that we've seen this year to official development assistance are expected to have a severe impact on some of the most vulnerable economies in the African continent. At the same time, the expiration of the African Growth and Opportunity Act in the US is likely to have similarly negative consequences for affected countries in Africa. Now here, looking at international credit conditions. On the graph we see here, what we have is the change in the 30-year government bond yields since the beginning of the year in four of the largest and most important advanced economies. So generally speaking, when we see tight macro, and we've seen from the chart obviously that those yields have gone up during the course of this year. So that kind of ongoing tight macroeconomic financial conditions internationally also continue to hinder global growth prospects. So as I said, although financial markets have recovered from the turbulence we saw in April, bond yield volatility remains very high. This uptick in increase in government bond yields that we see here has been largely driven by increased uncertainty, and that uncertainty is pushing up what's called the term premia. Term premia is the amount by which the yield on a long-term bond exceeds the yield on a shorter-term bond, and that reflects the amount investors expect to be compensated for lending for longer periods. So concerns around public debt trajectories are a key factor, most notably in the United States, due to renewed tax cuts in July of this year it was. Now, the direct impact of rising government bond yields on debt servicing costs is particularly worrisome given elevated public debt levels. Increased bond yields, although they do not immediately translate into higher government interest payments, but that does occur over time as existing bonds mature and need to be refinanced by issuing new bonds at the prevailing yields. Now, the indirect impact is equally worrying, as increased bond yields in the major developed economies puts upward pressure on global interest rates, and tight international financial conditions in turn strain public finances in developing economies, many of which will soon need to refinance significant shares of outstanding public debt. Moreover, government bond markets also play a key role in broader capital markets, serving as the foundation for a range of other financing vehicles that directly influence the borrowing costs of both households and companies. Now, in light of the current conjuncture that I just described, the question is, what are the key areas of policy action that we see as most important to shield economies from the adverse effects of the current shifts? The first area is public finance. We see the need for a critical shift in the trajectory of national public finances in order to boost fiscal revenues through a more progressive taxation structure. In the context of increasing debt servicing costs, falling external financing, and growing public investment needs, we believe governments need to enhance revenues to ease spending constraints, which otherwise hinder expenditure and investment, as well as the capacity to enact counter-cyclical policies to manage demand shocks. Internationally, harmful practices covering tax avoidance, base erosion, and profit shifting continue to drain fiscal revenue from developing countries, and they can undermine financial stability. So in this regard, greater international tax cooperation is vital to address these kinds of harmful practices. Increased concessional finance is also needed to support development objectives, particularly in the most vulnerable developing countries. And coordinated global policy actions encompassing both concessional financing and debt relief are critical to mitigate growing vulnerabilities. Now, a second key area of action is in reducing exposure to prevailing trade shifts, and that we feel is best done through deepening regional integration and export diversification. When a country's exports, obviously when it has multiple destination markets, businesses can more easily adapt to shifts or downturns in any one particular market. An example of this we saw recently with China. China was able to reroute its exports to alternative markets amid the tariff escalation with the United States. And that shows how, through market diversification, countries can cushion the impact of sudden shifts in any one market on both revenues, export revenues, and production. So regional initiatives can help diversify productive structures and prevent excessive reliance on particular products as well as particular markets. And at the same time, they provide a potential bridge to global trade integration based on higher value-added goods. In parallel, looking beyond manufacturing-led exports and seeking to create quality jobs in the services sector, by seeking to create quality jobs in the services sector, including in non-tradable services, we see that as a potential alternative growth model for developing economies. And in fact, in last year's Trade and Development Report, there was a whole section dedicated to that. So I encourage those interested to look back at that publication. And finally, there's the issue of multilateral cooperation. We think that multilateral institutions are crucial in mitigating the potentially negative spillover effects of policy decisions in one country on others. More generally, multilateral cooperation and coordinated policies are needed now more than ever to avert economic fragmentation, to revitalize and sustain long-term growth, and to tackle global challenges. Now, quite quickly, I just wanted to cover two key issues which have emerged this year. The first is to do with the role of the dollar in the global economy. This year, there's been much talk of what could be perhaps an evolving role for the US dollar in the international monetary system. And that's in light of certain unusual patterns that we've seen during the course of this year. So here, I'll just try to unpack quickly some of the main developments we've seen this year and the implications that they may have going forward. So I won't spend too much on this. We're generally talking about the role of the dollar. As we all know, the dollar, of course, is the dominant and central currency in the global economy now. Its rise to that status was a gradual one. It began in the 1920s and 30s as it started to replace British pound sterling. However, it was in the aftermath of the Second World War, when we had the signing of the Bretton Woods Agreement, that we really saw the official establishment of the US dollar as the global anchor currency. And that lasted all the way through to the early 1970s. At that time, the US administration chose to end the convertibility of the US dollar to gold and all the other exchange rates which had been fixed to the value of gold. And that precipitated a period of unpegged exchange rates, and we saw a rapid increase in global capital flows. Now, we could have thought at that stage that once that official global anchor of the dollar had been lifted, we might have seen a smaller or diminishing role for the dollar. But in fact, it was quite the opposite. What we saw was an explosion of global capital flows, and it was the dollar which was, of course, the currency that anchored that increase in global capital flows, and that's continued through to this day. We've had many changes, the advent of the euro, the rise of China, but we have, for the most part, continued to see the US dollar remain as the central and dominant global currency. And that dominance is reinforced through a series of complementarities and network effects which reinforce each other and reinforce the dominant status of the US dollar. Now, for the most part, as I said, we've seen stability in the dollar status. Its centrality and its functions, both as a currency for foreign bank loans and deposits, for foreign exchange transactions and global payments, as an invoicing and settlement currency for international trade, and as a global investment asset, have all remained largely intact. In fact, the share of the dollar in these different functions has remained more or less the same since 2000. But there is one area in which we've seen some shifts away from the dollar, and that has been in its role as the global reserve currency. The share of dollars that make up the basket of central banks' international foreign currency reserves across the globe has declined significantly over the last 20 years or so. In this chart here, what we see is the share of each of the main reserve currencies in central banks across the globe basket of international foreign currency reserves. So what we've seen is this is not over a short period of time. Through these last 20 years, we've persistently seen a smaller role or a diminishing weight share of the US dollar over that period of time. So that does indicate to us that, at least in the case of monetary authorities, they are beginning, or they have been, giving priority to other factors that would lead them to perhaps lead slightly away from the dollar in deciding the makeup of their international foreign currency reserves. But again, while we have seen a diminishing share of the US dollar, that has not been reflected in the ascent of any one particular currency. What we've seen is that for an array of different reserve currency, we've seen very small increases, which has meant, again, in this chart, what we see is the share of each currency in the basket of central banks' reserves. And as we see, the blue chart is the US dollar. It has diminished, it has declined significantly over the last 20 years. But again, what we've seen is just small incremental increases in a number of different currencies, not one particular currency, which has suddenly shot up and begin to challenge the US dollar. We did, to a certain degree, see the euro increasing a lot at the beginning of the 2000s, but then in the aftermath of the global financial crisis and the euro crisis, we then saw subsequently the share of the euro again went back down. And here I should make just a point. This, the data analysis we're presenting here is specifically to do with foreign currency reserves, and that by definition does not include gold. Monetary gold is not included here. And it is true that we have seen specifically, especially very recently, a sharp increase in, if we look at total international central bank international reserves, including monetary gold, we have seen a sharp increase in the weight of gold, monetary gold in central banks' reserves. And that, again, could point to a certain softening in demand from monetary authorities for US dollars. But a great deal of caution has to be exercised when looking at that, because in the case of gold, obviously it's a very different asset class to foreign currencies. It's not issued by any particular monetary authority, and that, for that reason, it doesn't confer any particular advantages to any particular country or monetary authority. And at the same time, although we have seen a very significant increase in the share of gold, that is mostly due to price effects, not so much volume effects. The price of gold has gone up, I think, almost doubled in the last 2 years. And obviously that means that the market value of gold in central banks' reserves has also gone up a lot. But that doesn't necessarily mean, although they have increased their purchases, the majority of the reason for the increase we see in gold is because of price. So again, it's just to say that gold is significant, but it has to be dealt with certain caution when we start doing this kind of analysis. So, I mean, having described all, what I just have, and it does seem for the most part the dollar's role up until very recently doesn't seem to be challenged, it is fair to ask, what is all the fuss about then? There doesn't seem to be much to see here. The dollar is the dominant currency and appears to continue to be so for the foreseeable future. But this year we have seen certain strange or atypical patterns which could potentially suggest a shift, a more fundamental shift is occurring in that regard. In the chart we see here, the blue line, that is the yield, the interest rate, let's say, on U.S. treasuries, on U.S. government debt, and the red line is the United States dollar index. It's the exchange rate of the dollar against a broad range of other currencies. Now, when we saw at the beginning of April the announcement of reciprocal tariffs by the U.S., as I said, we saw heightened volatility and distress in international financial markets that were caused by that. So in that kind of market turmoil, what you invariably see is investors moving away from riskier assets and into what they perceive as being less risky assets. So in the past, that would mean principally you would see a shift towards the US dollar and US dollar assets. So in that kind of situation, what you would usually see is a fall in US Treasury yields and an appreciation of the US dollar. But as you can see in this instance, we saw the exact reverse. The opposite occurred. The blue line you see goes straight up, which doesn't go straight up, but it starts moving upwards, which reflects the Treasury yields actually went up in the aftermath of those financial distress, and we saw the U.S. dollar depreciate quite significantly, as we can see from the red line here. Now, again, that's very unusual to see such a trajectory in the context of financial distress. Sorry, let me just. So that could potentially point towards an important shift, as I said, in the perception of United States assets. Now, it's too early to say yet whether that was simply something that can be put down to very specific cyclical factors, or whether it does actually represent a longer-term erosion of the perception of United States assets. So it remains to be seen what will actually happen there, but it is an interesting point, and it is something that needs to be monitored going forward, because it could have potentially very significant consequences and ramifications for the international monetary architecture going forward. And in that context, we think efforts to establish alternative arrangements for countries to avoid overexposure to the dollar are increasingly important in steering and shaping what could be an evolving international monetary and financial system. And specifically, if such arrangements, alternative arrangements, can be and should be organized in a way that better serves the needs of all countries. Of course, the US dollar dominance, it confers significant strategic advantages to the United States. But for other countries that see themselves at least obliged to conduct trade in the US dollar, to take out debt in the US dollar, that obviously signifies a significant vulnerability for them. And to the extent to which in this environment that an alternative arrangements which already are underway, there are several different initiatives across the different developing regions underway. In the report we'll go into some more detail about that, but I think they could be a starting point towards moving towards an international system that is perhaps more multipolar and provides more options for developing economies. And the last topic I would like to quickly cover is that of external imbalances, which has been at the front and center of the global policy debate this year. So I'd like to take this opportunity to provide an analytical framework that enables us to view and assess those external imbalances from a slightly different perspective. So very briefly, when we talk about external balances or external imbalances, what are we actually referring to here? Well, the international transactions that a country engages in is recorded in what we call a balance of payments. And that balance of payments is separated into different accounts. On one side, we see the current account. On the other side, we see the capital and financial accounts. Now, broadly speaking, these two, they are to a certain degree two sides of the same coin, as in when we see an imbalance, a positive balance, a surplus in the current account side, what we'll see is a deficit in the financial and capital account side, and vice versa. But when we hear a lot about external imbalances, what people are generally talking about, or what they're referring to, is the current account side. The current account is made up of 4 different balances. That's the trade in goods, the trade in services, a primary income account, and the secondary income account, which is also known as current transfers. Now, goods, the trade in goods we all know. Likewise, the trade in services we know as well. Services more traditionally have been things like transport and logistics, but also tourism. But recently, we've seen increasing importance of more technological services, digital services. And then we also have the income account, the primary income account. To give an example, if a company invests, say, in another country, though the interests or profit that are derived from those investments, when they're sent back to the home country, that is recorded in the primary income account. And finally, current transfer, most notably there is what we see as remittances. When a worker from one country goes to another country, works there, but then sends money back home, that is recorded in the current transfers balance. Now, when we see imbalances in the current account, typically what is driving that imbalance is the goods balance. Now, that's not always the case. Sometimes there are certain countries which are specialized in services. There are certain other countries, for example, in Central America, where we see remittances, which make up 20-25% of GDP, and obviously in that case, its current transfers will, to a large degree, drive the overall balance of the current account. But typically speaking, when we see an imbalance in the current account, it's due to an imbalance in the goods account. So on the face of it, an external balance is exactly that. It's an entirely external phenomenon, and it's determined by the international transaction that a country engages in. However, contrary to this appearance, macroeconomic accounting identities actually show us that the current account balance is not only equal to the difference between receipts and payments of international transactions, it's also equal to the difference between domestic national saving and investment. Essentially, a current account deficit or surplus doesn't simply represent an imbalance in external accounts. It also reflects internal imbalances that occur when the domestic investment rate persistently exceeds or falls short of the domestic savings rate, the national savings rate, which is the savings, the aggregate savings of the household sector, the corporate sector, and the government sector put together. So looking at an example here, we have the savings, investment, and current account balance of two countries. On the left is the United States, on the right is Germany. Now, the United States is the country which runs a current account deficit, and that again is due to its trade in goods. It imports far more goods than it exports. In here we see that the red line here represents its savings rate, and the blue line its investment rate. And we can see persistently its savings rate is higher than its investment rate is. The red line is investment rate, the blue line is the saving rates. What we see is the investment rate is persistently greater than its savings rate. And that gap is reflected in the current account deficit. And we see when the difference between savings and investment shrinks, we see a shrinking of the current account deficit. When we see it widens, we see which is what has happened in recent years, we see a widening of the current account deficit. And the contrary is the case of Germany. Germany is a country which saves more than it invests, and as a result, it has a surplus in its current account, which has been widening in recent years. So we can see that, in fact, domestic macroeconomic trajectories can therefore be key in assessing countries' external imbalances. And a multitude of factors that include domestic private demand conditions, fiscal stances, productivity stances. I'm sorry. Slow down. Okay. Okay, sorry. So we can see that domestic macroeconomic trajectories can therefore be key in assessing countries' external imbalances. So a multitude of factors, which include domestic private demand conditions, fiscal stances, productivity paths, amongst others, impact both directly and indirectly saving and investment outcomes that in turn underpin the trajectory of external accounts. Now, why is this important? Well, it's important because if a country or a group of countries is going to try to address external imbalances or bring more balance to their external accounts, what is the right strategies, what are the right policies, or what are the most effective policies that can be adopted to try to achieve that objective? Now, it is not uncommon for external imbalances to prompt trade policy measures such as tariffs to try to balance imports and exports. By increasing the costs of imported goods, tariffs tend to have a dampening effect on import demand, which, when occurring in isolation, can close the gap between exports and imports. However, there are also dynamic general equilibrium effects, aggregate effects, when these kind of policy actions are adopted, and these can have unforeseen consequences once all the effects are aggregated. As a result, the aggregate impact of these kinds of measures on external balances tends to be more ambiguous. In fact, empirical studies have found that the overall impact of tariffs on aggregate trade deficits can be very limited. That may appear counterintuitive, but there's a combination of factors in play here. Any reductions in imports achieved through tariffs are also, are often, I should say, accompanied by similar reductions in the exports of that country. That's due to resources being drawn away from exporting activities in the country to attend to what is now demand which is no longer met through imports. Also, particularly nowadays, since production processes increasingly involve cross-border supply chains, tariffs can actually raise the costs of imported inputs for export-oriented manufacturing. So in this way, tariffs can actually act as a tax on both exports and imports, and that leads to the net effects on overall external accounts that can be very uncertain. So in order to take account of these possible secondary effects, it can be useful to assess the dynamic effects of changes on both savings and investment rates. And in this way, we're able to better see the final aggregate effects of different policy choices on overall current account balances. And it also, by taking this approach, it also opens up the possibility of designing policy options that focus on the factors that lie behind domestic imbalances, which in turn can bring about a rebalancing in external accounts. So specifically, those economies that exhibit external deficits can look to bolster saving. In instances where external deficits are driven by excess dissaving in the public sector, that is a deficit, a public deficit, a fiscal deficit, a reorientation of fiscal trajectories based on more progressive and enhanced domestic public revenue generation can impact favorably on external imbalances, while at the same time limiting negative impacts on the domestic economy on the whole. On the other hand, in surplus economies, policy measures that boost domestic demand and limit excess saving, such as more expansive fiscal stances, strengthening of social safety nets, and more active labor market policies that boost labor income and therefore boost consumption, can serve to bring external accounts towards balance, as well as leading to positive outcomes in terms of income inequality. Similarly, domestic policies and regulations, particularly regarding the financial sector, can impact saving and investment decisions through their influence on both the conditions and allocation of credit. And finally, collective and coordinated international action among countries operating excessively positive and negative external imbalances can greatly facilitate addressing such global imbalances. We believe a nuanced approach that combines both national and coordinated international actions would be most effective in addressing external imbalances, while at the same time limiting the negative fallout from macroeconomic adjustments, both domestically and globally. We think internationally corrective action demands a multilateral policy response focused on more coordinated approach to global economic governance, a more cooperative approach to policy challenges for trade, industrial policies, and taxation, among others, could minimize potential negative spillover effects and avoid adverse impacts on the most vulnerable economies. And similarly, as I said before, regional integration initiatives need to incorporate integrated policy mechanisms spanning trade, financial, and macroeconomic priorities. So with that, I'll pass over to my colleague Nicolas, who's going to present the main trends in international markets.